Hello and welcome to Part 1 of the USDA New Lender Training course for the Single Family Housing Guaranteed Loan Program. I'd like to begin our presentation today by extending a heartfelt thank you to each of you. Your dedication to offering affordable loan options for rural homebuyers and your personalized support truly makes a difference. Together, we can help individuals and families as they begin their journey to homeownership. The new lender training course consists of 5 parts. In Part 1, we will discuss the key highlights of the Single Family Housing Guaranteed Loan Program, loan purposes and terms, and applicant characteristics. Once you've completed viewing all 5 parts of the new lender training course, you will be ready to complete the required knowledge quiz through the link provided by USDA to your organization's point of contact. You must receive a passing score to consider this training complete. You may take the quiz as many times as needed. There are many reasons that the USDA Single Family Housing Guaranteed Loan Program is the #1 choice for many lenders and homebuyers. Let's take a look at those key benefits. If you are just starting to explore USDA loans, the upcoming slides will provide you with some insight into our organization and how our program plays a vital role in supporting and enhancing our rural communities. The goal of the Single Family Guaranteed Loan Program is to support low to moderate income homebuyers in rural areas, help homebuyers secure suitable, modest, safe, and sanitary housing, and ensure the availability of reliable loans that might not be offered otherwise. Our training today is highlighting the Guaranteed Loan Program. However, we want to take a few moments to go over another single-family housing loan option available to rural homebuyers, and that is USDA Rural Development's Direct Home Loan Program. There may be instances where you cannot assist low-income applicants due to their income levels not supporting adequate housing within their repayment capacity. In those situations, please encourage the applicants to reach out to their local USDA Rural Development office for details on how to apply for a direct loan. The key differences between the programs are the household income requirement, how applicants apply, and who funds the loan. Guaranteed applicants must have an adjusted annual household income that does not exceed moderate income limits, and direct applicants must not exceed low income limits. Guaranteed applicants will apply through a participating lender, and an approved lender will fund and service the loan. With the direct program, applicants apply directly with USDA Rural Development, and Rural Development funds and services the loan. A few additional differences highlighted on this slide include property and interest rate requirements. As you can see, both are great options for rural home buyers. Our nation's rural areas often face unique challenges when it comes to accessing affordable housing and home loans. Limited housing options, lower income levels, and fewer lending opportunities make it difficult for individuals and families to become homeowners. USDA's Guaranteed Program is specifically tailored to address these needs. We work closely with our lenders to understand the specific requirements for the rural areas we serve. With no down payment required, flexible credit requirements, and no maximum purchase price limits, homebuyers have access to affordable financing. This empowers individuals and families to achieve their dream of homeownership. As a lender, you have the power to shape the lives of individuals and families by providing them with the opportunity to secure a home loan. By partnering with USDA, you can expand your reach and make a positive impact in the communities you serve, because with our guaranteed loan, you are getting up to a 90% guarantee, and mainly due to their low prepayment rates, USDA loans receive premium pricing on the secondary market, and another great benefit is that USDA loans count towards CRA credit. Our Guaranteed Loan Program team consists of highly skilled staff, including loan reviewers and training specialists. They bring a wealth of knowledge and experience to the table and provide the support you need. Next, we're going to take a look at loan fees and eligible loan purposes. USDA's loan fees allow us to operate as a budget-neutral program and allows us an opportunity to modernize our technology systems, making the loan process as streamlined and efficient as possible for lenders, all without utilizing taxpayer dollars. There is an upfront guarantee fee of 1%, which can be included in the loan amount, an annual fee of 0.35%, which is based on the scheduled unpaid principal balance, and lastly, a technology fee of $25, which applies to all loans that are submitted through USDA's automated underwriting system, GUS. When it comes to calculating the maximum loan amount, an applicant is permitted to finance reasonable and customary expenses associated with purchasing a home if the total amount financed does not exceed the applicant's documented repayment ability and the appraised value of the property. It is permissible for the loan to value to exceed 100% of the appraised value if the excess amount represents the financed upfront guarantee fee. The maximum loan amount is calculated by dividing the appraised value by 0.99. This results in a loan amount which includes the upfront 1% guarantee fee. USDA does not have a cap on interest rates that lenders can charge, but there are a few things the program does not allow. And those include adjustable rate mortgages, balloon mortgages, negative amortization, loan terms less or more than 30 years, and prepayment penalties. A USDA loan can be used to purchase an existing home or to construct a new home. Income-producing buildings and land are prohibited. There are no limits on the amounts of gift funds, but contributions from sellers and interested parties are limited to 6%. Rehabilitation and repairs can be part of a purchase, but there are no products to renovate a home the applicant already owns. While we allow refinances of USDA's existing rural development mortgages, there are no allowable circumstances for cash-out refinances. And of course, funding can be used for closing costs and customary purchase expenses. Let's discuss the refinance options in more detail. As noted earlier, only loans that are currently financed or guaranteed by USDA qualify. For all three refinance types, the Streamlined Assist, Streamlined, and Non-Streamlined, there are some key requirements. The existing loan must have been closed at least 180 days before requesting a conditional commitment and must have no defaults within that 180-day period. It must have a fixed interest rate with a 30-year term, and the household must meet annual income limits. Cash out from collateral equity is not allowed. Borrowers can only get back eligible prepaid closing costs and any escrow overages. Additionally, borrowers must live in the property, and for properties now in areas considered ineligible, those can still be refinanced. Finally, any existing leverage loans or subordinate liens must be fully paid off or subordinated. The Streamlined Assist option is the most favored and effective refinancing choice. This is because it does not require a new appraisal unless the borrower has a USDA direct loan with recapture subsidy due. One limitation with the Streamlined Assist, though, is that only deceased borrowers can be removed. If a living borrower is looking to be removed from the loan, the remaining borrower must choose between the streamlined or non-streamlined options. When reviewing credit history, Streamlined Assist only requires verification there have been no delinquencies greater than 30 days within 180 days prior to loan application. Streamlined and non-streamlined will also require a full credit review per Chapter 10 guidelines. All options allow refinancing of the principal and interest balance, eligible closing costs, and upfront guarantee fee. If the borrower is looking to include subsidy recapture, the non-streamlined option would be required. All refinance options will be entered into GUS and have supporting documentation uploaded to the application. However, due to the limited loan information available for a Streamlined Assist loan, you will not be able to process a final submission in GUS for these loans. You must follow the guidance in the Manual File Submission Process Guide for Streamlined Assist refinance loans. We will discuss submitting manual files according to the Manual File Submission Job Aid later in the presentation. One of the key lender benefits of a guaranteed loan is the guarantee coverage of up to 90% of the loss incurred by the lender. So let's take a closer look at that calculation. This example will help illustrate how the loss payment is calculated per Chapter 19 of the handbook. If the loan's original principal amount was $100,000, the maximum loss payment will be the lesser of $90,000, which is 90% of the original principal amount, or the calculated amount based on the second bullet shown on this slide. So let's walk through that calculation. First, we find 35% of the original principal amount, which is 35% of $100,000, giving us $35,000. Next, we calculate 65% of the original principal amount, which is $65,000. Now we need to find 85% of that $65,000. This gives us $55,250. To finish the calculation, we add $35,000 and $55,250 together, resulting in a total of $90,250. In this example, USDA's exposure would be capped at $90,000, which is the lesser amount. Next, we are going to review the key requirements of applicant eligibility. The first key component of applicant eligibility is determining if the applicant currently owns a home, and if they intend to retain that home, are they eligible for a USDA guaranteed loan. A borrower can retain another home, but the following apply. The current home cannot be financed with a USDA direct or guaranteed loan, as USDA borrowers can only have one USDA home loan at a time. They must financially qualify to own more than one home. The home being purchased must be their primary residence. The retained home must no longer meet their needs, such as there is a need to relocate for work reasons, they require a larger home for their family, or other acceptable situation deemed acceptable to the lender. While we have provided a few examples, they do not represent every possible scenario, and it is the lender who will make the final determination. The lender must document justification in the permanent loan file. Both the applicant and lender certify on Form RD 355521 that the applicant does not qualify for traditional conventional credit. Before checking that box, how does the lender determine the applicant meets his criteria? The lender must compare the loan terms and borrower eligibility of a USDA loan with a conventional loan. If this review determines the applicant would be eligible for a conventional loan with similar rates and terms of a guaranteed loan, the applicant may be ineligible for a guaranteed loan, as this review suggests they do not need the guarantee to obtain an affordable home loan. It's important to note that this comparison does not apply to FHA or VA loans. Applicants can be eligible for a FHA or VA loan and still obtain a USDA guaranteed loan. The guidance on this slide applies to conventional loans only. This past year, Chapter 8 was updated to provide lenders with guidance on carefully examining asset accounts. It is important to ensure that assets are not moved between personal and business accounts. These accounts should be treated as separate financial tools, one for personal use and one for business use. If assets from both accounts are mixed together, the combined assets will be considered in the credit assessment. When it comes to occupancy requirements, borrowers must occupy the home as their primary residence, and they must occupy the home within 60 days of loan closing. Active duty military applicants must occupy the property as their primary residence and express intent to meet occupancy requirements upon discharge from the service. A military service person who cannot physically reside in a property because they are on active duty will be considered to meet occupancy requirements. All borrowers must be run through SAM.gov to confirm they have not been suspended or debarred from participating in federal programs. If they have, they are not eligible for a loan with USDA. Further guidance has been provided in Chapter 8 regarding applicants that have been excluded from a non-housing federal program. Keywords here are excluded and non-housing federal agency. Applicants that have been excluded from a non-housing federal program continue to be eligible to participate in the single-family housing guaranteed loan program unless the individual becomes suspended or debarred pursuant to 2 CFR Part 180 and 417. Applicants that are excluded from federal housing programs or excluded from all federal programs are ineligible to participate in the single-family housing guaranteed loan program. Once you have completed the verification in SAM.gov, you will fill in the information on the additional data screen in GUS. Fill in the date SAM was checked and whether the borrower has been debarred from doing business with the federal government. Note that checking yes to this question will return an ineligible response in GUS, as it's actually indicating that the borrower has been debarred from doing business with the federal government. If they haven't been debarred, make sure you select no. To be eligible for a guaranteed loan, the applicant must be a U.S. citizen, a U.S. non-citizen national, or a qualified alien. A change in regard to the SAVE system was implemented on April 1st of 2024. This system was used to run the borrower's information to determine the applicant's legal residency. That system has recently been removed, and it is now the approving lender's responsibility to document the applicant's legal residency. The approved lender should collect all necessary documentation needed to validate their eligibility, and it must be retained in the permanent case file. This wraps up Part 1 of the New Lender Training course. You can now proceed to Part 2, where we will discuss income requirements.